What's up, guys? So I haven't made a long form video in about a week. I wanted to talk about the post I had earlier this week about the economic outlook. So that's what this video is going to be about, of how there could be a possible downturn. I'll give their view of it and I'll give my view of it in a sense. I guess that's the only two ways. Well, I guess I could give you a bullish view, which is, well, it'll be my view. So basically, I'm not going to lie. One of the things that really caught me off guard when I watched the video and these two gentlemen were talking, and these guys are like actual economists, right? They've been doing it for like decades, right? They explained quantitative easing at a little bit more depth. And if you're a new follower, then you probably, I'm not saying you don't know what quantitative easing is, but I remember posting about it when I first started this page. And what quantitative easing is it gives the Federal Reserve, they're supposed to theoretically be pumping liquidity into the market. And what that means is they're printing money and throwing it into the economy, so there's more dollars out there. They do this by they buy loans from banks. They buy stocks from the open market. They'll buy bonds from the open market, and they'll keep it on their balance sheet. And I was under the impression, so let's break this down. So essentially, like, let's say if you went out today and you went to, Wells Fargo or Rocket Mortgage or Chase Bank, wherever, and you wanted to buy a home for you and your family, and you bought like a, nice 4-bedroom home. It was, let's say, $500,000. The bank, you would pay the bank 20% or 5%, whatever, like $100K down, and, you would owe $400,000, right? You would go on with your life and you would continue to make payments on that $400,000. Of course, you could refinance or whatever, that's okay. But that money, the bank, if I'm Wells Fargo, if I'm whoever the heck it is, I paid someone that $400,000 and now I'm collecting from you. What they would do is then take that money and the Federal Reserve, they would take it and say, we're going to take this $400,000. And you would think that what they would do is they would then give the bank that 400,000. That way the bank has 400,000, like, yay, we have a bunch of cash. And banks hate holding cash because the only way the banks make money is off of interest rates when they loan money out to you, and, charges and a bunch of other fees and services they have, but mainly it's interest rates. That was the impression that I was under. But this economist, the way they broke it down is that's really not what happens. What happens is when the Federal Reserve takes that $400,000 loan, they don't deposit $400,000 into Chase Bank or into Rocket Mortgage, whatever. They give them a security deposit saying, you have a $400,000 credit, you just can't really access it. So that's what really threw me off, because I was under the impression like, oh, okay, they got the cash and they're going to be able to loan and lend, and that's how it's good. But it's not. It's just the way to remove. They're pumping air quotes liquidity because they're taking dollars out, they're adding it to the balance sheet, and then they're essentially saying to you guys and saying to banks, hey, don't worry, no matter what, we'll buy the loan. But it's only going to be in the form of a credit, but it's stopping banks from making money. So banks are like, well, okay, if you're going to buy this and we're not really getting anything out of it, it's not in the bank's interest to have the Federal Reserve buy it. Why? Because if I loaned it out to you, if I'm Wells Fargo, from who, and I'm supposed to be collecting, or whoever I am to sell it to you, I'm supposed to be collecting 3%. But all of a sudden, I just made my loan origination fees or whatever. I made my little profit off of it. And then I got to give this $400 to the Federal Reserve, and they're going to hold it on a balance sheet. And, those interest payments that I'm making or whatever, it's just really going back to them in a sense. I'm not making any money. So then I'm like, well, I want to hold and retain some of my loans and stuff, right? Like, so that would be the name of the game. But then you're kind of scared, especially, and this is where this starts rolling in. And it's happened to me, guys. I'm still working on a deal, knock on wood, hopefully it ends or, closes up in the right way, and I'll make a video about it and what I did and my experience and all that. But banks are really tightening lending. And that's one of the first things I did, because banks are saying, okay, we want to be able to retain these loans. And if we are lending money, we want to be able to make real money, because we're going to hold your money in a sense, right? We're not going to just pass it to the Federal Reserve or whatever. So they're saying, how do we get the Federal Reserve to stop taking our loans and doing stuff? Well, they're the ones that are coming to a halt. They're saying, no, you want to buy a home? Sorry, we're not going to lend to you. Or you want to buy a 4-plex, you want to buy a 5-plex, a 10-plex, we're not going to lend to you. You need a line of credit, we're not going to lend to you. When that starts, tightening up, money stops being circulated. And once all this happens, the tightness of it will lead to an economic downturn. Sorry, I'm looking at my notes too. And it says the dollar looks like it's going to be breaking out. Why? Because it's simple economics, right? When there's less of something, there's more of demand for it, right? Supply and demand, right? And so when liquidity is drying up, because the bank's saying, no, we don't want to loan to you, it's going to cause the dollar to be worth more because there's less money out there. So the relationship with that would be, well, shit, okay, well, let's just take this example. If I wanted to go buy a rental property for $100,000, and the person that's selling it, they want to get rid of it for whatever reason, right? They want to put someone, one of their kids through college. They see a better investment somewhere, a million reasons, whatever. But they've made their mind up. They want out. If originally I only had to put down 20 grand to get the rest of the 80 from the bank or whatever, and now there is no bank there because the bank is like, no, we're not lending, right? We're not going to be able to give you that 80K. And that means there's going to be a demand for dollars because you're like, shit, I need to come up with $80,000 in order to close this deal because you want the deal. Now think about this, about the thousands of deals that are going on. Then all of a sudden, after a couple of months, 3 months, 4 months, maybe that deal breaks through, then the next deal breaks through, like breaks down. Eventually the person that's selling is like, well, shit, maybe I'm charging too much. I need to come down. And then what happens, instead of an inflationary period that we have a short-term deflationary period. Because somebody wants out of that property, they want out of that asset, there's not enough cash to cover it, so prices have to come down. It's doing the total opposite of what the Federal Reserve wants to do. So that's one way that I thought. So when I was reading through it, it made a lot of sense to me. It's like, we are a debt-based monetary system. We need to continue to create debt in order to expand, to keep the game going, right? Because, maybe the banks don't get the cash, but investors will. If I pay you $100,000, I put 20 grand, the bank put in 80, you got the 100, money expanded, right? The debt expanded there. You went off and you took that 100 and you took that and you bought a $500,000 apartment complex. So you put your $100,000 down, then the bank gave you 400. See, the debt is expanding. The economy is expanding. But if we don't have that, then it's contracting. And that's when prices will go down. That's what they're fearing is going to happen. And also they're saying there's going to be the biggest catalyst in this is going to be the fear of commercial real estate and people not paying with the moratoriums and everything else in place. That's going to be the biggest catalyst that's going to cause banks to even say, well, no, we're not loaning more. And the economy will start shrinking. And of course you have the euro dollar system. Fancy ass way of saying it, guys. It's not that complex of a thing. It's just dollars that have made it out of America that the Federal Reserve or any regulatory body of America can't have access to, right? So it's like British, or I'm trying to use, Apple. Apple went and said, hey, we're going to deliver 1 million. This is all hypothetical. I'm just using Apple as how dollars got there. We're going to have $1 million of iPhone, or 1 million iPhones sent over to London. Okay, London, you want these 1 million iPhones, you got to pay us $1 million in American money. So then they scramble and do whatever to get American money. Now that American money is over there in London, we don't have access to it. But it's in Europe, right? It's that $1 million is being circulated amongst those governments, amongst those companies, and they're settling those debts. That's the euro dollar system. And a lot of the debt that's issued, like corporate bonds and whatnot, is sometimes it's issued in the American dollar. And you need American dollars to service that debt. Like if I borrowed $1 million, on a corporate bond at like 5% or whatever the hell it is, I need to be able to come up with that payment with American dollars. And if there's a shortage of those American dollars, the only way that you could do it is those foreign entities will have to dump treasuries and God knows what else. They'll have to sell it at a fire sale in order to get dollars to be able to pay it. And why is that? It's because our Federal Reserve and our Treasury, we can't print for other nations, right? And in order for that to happen, they have to use the dollars that are only in their system. So that's another huge problem that they could see rolling in. So when that happens, it's like, well, can the government save us? Maybe if they end up giving us another round of stimulus, or they come in and bail out, GM and God knows who else again. It really depends on how our citizens react. If we're like, oh shit, we've seen this one too many times, start saving up money, honey. Pay off the credit cards. Let's not go out and eat tonight. Let's save more than spending. That's also going to contract the economy even more. It's a vicious cycle until something kicks it up. Like a world war happens, or a government comes in and says, we're going to do a Green New Deal. I'm just using that example. I don't think the Green New Deal is a good plan, but still something like that, where the government steps in or builds highways or whatever to get the economy working, to get more money, to make you feel like, how I can spend again. So, there will be a correction in stocks and in real estate if the dollar shoots up in value, because there'll be less lending available. There'll be a higher demand for dollars, therefore asset prices would go down to kind of wrap it up. Global interest rates will have to rise in order to combat that stuff, and overall volatility will rise. And the central banks will have to print to buy assets. So central banks around Europe and everywhere else will have to start doing more quantitative easings. When stocks start dropping, things start dropping, those banks are going to have to print more money to buy those assets out. And that's what they're thinking. And for me, it's like, I still think deals could get done. They have to be really good deals, and you got to have a good relationship. And I'm still very bullish on America. So I still believe that the biggest threat is going to be political uncertainty here. Whether it's the left taking control and changing policies radically, or if it's rather, if it's Biden that wins and Trump says, I'm not leaving, like, that is not what we need right now. We need, certainty, and we need clarity in order to continue to invest. Those issues about money drying up and things happening, I mean, if we look back at 2008, everyone thinks that another 2008 is coming, right? We were either so young in our lives that we saw things go cheap. We saw like Citibank at like $5, Wells Fargo at $10, and we think, oh, that's going to happen again. Oh yeah, I'm going to be able to pick up a rental unit for $50,000 again. Oh yeah, everything's going to get cheap again. It always does, right? Let me just tell you something, guys. That's only really happened in 8 times in our lives. And out of those in our lives, in the last 100 years. And out of those 8 times, when everything's dipped, it has never dipped as bad as 2008. There's a reason why when we talk about 2008, we say the great financial recession. We don't just say, oh, the recession of 87. Oh, the recession of 90, the dot-com bubble of 99. No, we say the great financial recession. We say the Great Depression, right? It was great. Like, not in a good, ironically, it wasn't really great because a lot of people suffered. But that doesn't happen, guys, every 10 years. There is boom bust cycles. There's a business cycle. Products lead to the end, and an innovation happens because things are, plasma TVs aren't the new thing. Now it has to be LCD. LCD is not the new thing. Now it has to be HD. HD is not the new thing. Now it has to be QE-LED or 4K or 8K. You see that there's the business cycle that has booms and busts, but the whole financial sector going boom and bust, guys, that doesn't happen every 10 years. That doesn't happen every 15 years. That happens usually every 30, 40, 50 years. The next thing I could see happening that's that great, that's that grand, is when the dollar blows up. And that's a whole nother conversation. But in the short term, will prices go down? Yeah. But you can't have that mindset if you're an investor, if you're just starting off, if you're, even if you're working at McDonald's and you're only saving a couple $100s a month to invest, or you have a great career and you're starting out and you're making like $70, $80K or grand a year, and you can't just be on the sidelines and be like, well, I'm just going to wait for everything to drop, because that doesn't always happen. My advice is dollar cost average down. That means if you really, really, really love a company, you really love this new Nikola that came out, so what, you bought at $50. Don't buy in the next 2 months. Wait, see what happens to the stock price. If you still like it, then buy a little bit more. Only buy 5% at a time, and you'll never be really hurt that bad, because you could leave without blowing up your account. That's my opinions on things. I hope this video kind of helped. I didn't mean to scare you and all these things. I just want to prepare you to kind of have your mind thinking if these things start popping up, if you start seeing headlines of defaults and stuff like that, that's possibly what could happen. Hey, hope you like this video. Please share this with a friend, help me grow the page. And of course, if you have questions, comment on the video, and I'll try to respond back as soon as I can.